Okay, let's turn our attention to some chart examples now that basically reinforce these primary lessons that we've seen here on just this simple weekly chart of sugar. I'll begin this process by just bringing us forward into the current climate here. We were in that period around December of '07, I think, at the far right-hand edge of the screen. So let's just bring ourselves current. That would have been right back in this area right here. Note that we had mentioned that both the fast and medium speed oscillators had crossed above the slow. Now, granted, in this environment, the slow is still below zero, but now we have at least two of the three complete steps necessary for a bullish environment. That is, the fast being stacked above the medium speed, which in turn is above the slow. And then they all come back into a point here. I wouldn't necessarily call this a singularity, but it is the kind of thing that you might be warned of. As long as the medium speed remains above the slow, you're still in a generally bullish climate, though it has not yet completely proven itself by virtue of the slow crossing the zero line. Here, however, is a case where this small move to the upside was enough to force the fast above the zero line. Now it's pulled back to the medium speed, and it's clearly above the slowest as well, giving us a very early indication that this market could be ready to take off. And of course, we get up here into this overbought climate by virtue of the fact that the fast oscillator has now moved above its upper standard deviation band, and the medium speed has too moved above its standard deviation band. Now we get into a situation where there's a complete crossover. This is, yes, we've turned bullish, but it's a warning now that when we get the crossover of the fast back below the other two, and particularly get this union or singularity or conjunction occurring by virtue of the small retracement back to the upside now that forced the fast back to the medium speed, we sell off hard again. So I suppose what you could say is that you're still in this basing period, at least from this weekly time frame, and the market is just going to have to prove itself. And basically, we just trade the oscillations at that point. We come down into the low right here. We get the angular turn in the shadow line, which is something we discussed with the triple STX. We get angularity coming from the turns in the fast component 4 line. And then the market rockets back, the fast line crossing back through zero and back to its upper standard deviation band here, indicative of potential topping action, which was confirmed by the medium speed oscillator as well. And basically the market just ranges back and forth. We hit the lower standard deviation band of the fast and of the medium in this bottoming process. The market turns back to the upside in a trend direction. Notice that the slowest oscillator has remained above zero here, still beneficial for the bullish cause, and now we finally get a formation where we get fast and medium speed, regular, back in a position of the bullish fan. We get a pullback, a singularity between the fast and medium speed at this point, and in fact, that overshoot that I had mentioned previously, we come almost down to the slow oscillator. We have basically a conjunction here. We have a 1-bar, this is on the STX, we have a 1-bar crossover. Remember, we had talked about the 1-bar crossovers in the STX. We have a 1-bar crossover of the slow STX, giving us a warning as to the likely ultimate way that this works itself out, and now the market takes off again back to the upside, staying in this bullish fan formation. And this is a case where I mentioned U.S. equity markets. Basically, you had very little angularity in the equity markets here in the first 4 months of 2010. However, they were remaining in their relative bullish formation, that is, with the fast above the medium, which in turn is above the slow. We get to these overbought conditions. The market then pulls back. We get into this triangle that's basically being formed in the market itself, and we had identified a couple of events here. So we maintained that same bullish position with the triple STX. So it's an example of these tools basically confirming one another. That is, by virtue of the way they're fanned out and stacking. Now at this point, because of the benefit of the standard deviation bands from the component 4 line, we can see that in this zone right in here, basically we have a scenario where both the fast and medium speed are hitting their lower standard deviation bands while above the zero line, a very bullish configuration. And we get that explosion in the market up to this top here where we're above both upper standard deviation bands yet again. So this is an example of weekly sugar. Here's another example in the same chart where we had identified the triple STX creating the conjunction. Here we are in a scenario where pretty much everything that we look for to happen is taking place. First of all, the slow component 4 lines below zero, indicative of a newly established downtrend, at least of some duration. Now the fast oscillator cuts back on its way to what we hope is a conjunction. It actually overshoots a little bit, which we said could happen, and it finds its own upper standard deviation band at the zero line, which we said would be the most bearish situation that there was. And simultaneous to that, the regular speed component 4 line has now come back. It too is resting right on top of the slowest of the component 4 lines. This is a very bearish situation, and then we get the price action confirmation here on this big down weekly bar. The market then sells off. We come back, and at this point, if you could even ask for something to be better than here, it is true that it is here, which is, once again, the fast component 4 line comes back to its upper standard deviation band at the zero line, and in agreement with that, the medium speed component 4 line comes directly back to the slow line, which of course is below zero. And note, importantly, it's a little hard to see, but note that the medium speed oscillator is resting right on its upper standard deviation band here, which was not quite the case in this area back here. This I would classify as a very bearish formation. And it again was one of those situations where you had the 2-bar crossover of the slowest STX all occurring right at the regular ocean moving average. Then the market, from this point right here, sells off. We don't know what the duration of the sell-off is going to be. We're monitoring, just from this indicator alone, we're monitoring the location of our standard deviation bands. Here we hit the lower standard deviation band of both the fast and regular, and immediately as the market rockets out of that location, the fast cuts above first the regular and then the slowest component 4 line, becomes positive, and ultimately then drags both the regular and ultimately the slow back across the zero line, and the market is free to advance again at that point. Here's another very near consideration of exactly the same kind of pattern occurring. Here's another condition where the fast actually came back above the regular, yet hit the zero line, and we had already identified this previously from our STX analysis. Okay, let's give TradeStation its due and switch over to an example of TradeStation as well. So here we are looking at a TradeStation chart, and I'm using the same example that we had previously used with the STX analysis, that is, in this case, the crude oil weekly. And we're just noticing these patterns and the way they develop. The oscillators are exactly the same. The colors are different here because of the difference in the color of the background. The fast is shown as a cyan. The medium speed is shown as white, both with their respective cyan and white standard deviation bands, and then the slowest in this case is orange. So you kind of have to readjust your mind to be able to pick up on the differences in coloration. But what we can see here, I'll just go from right back to left. At this point right here, and I've got this marked simply because it was the location where I came down and hit the lower standard deviation band of the medium speed component 4 line, as well as hitting the lower standard deviation band from the fast component 4 line, and we had this minor overshoot at that point of the fast beyond the slow, which of course had turned bullish back here by virtue of crossing the zero line. And that point happened to be one of those 1-bar penetrations here on price of the slow STX as well. Here's the location in time where we got the earliest warning possible that this market might be changing its flavor from bearish. Note up here we were in this bullish fanned position, fast above regular, which in turn is above slow. That remained the case. We were getting warnings through this phase in here as we were above the upper standard deviation band from both the fast and regular, but we sliced very quickly via the fast crossing below both the regular and slow, and then the zero line, thus dragging those two across zero as well. Here's the opposite scenario of that. That is, we have hit the lower standard deviation band throughout this entire decline via the fast component 4 line. We're now setting up a little bit of divergence And by the way, that's another thing this set of oscillators can give you, are divergences. It's not their strongest point necessarily, because as we'll see as we advance on, there are other tools within the Ocean Pro arsenal that are more responsive to price action in terms of being able to identify very clear divergences. But I would also, by the same token, not disignore divergences when they're taking place. So here's a divergence of the fast against price action, a rapid slicing through of the fast back above the regular and slow, being powerful enough in its move then to drive both the regular and slow ultimately back above zero, changing the flavor of the market. And this is that scenario where I talked about in equities as well, that we experienced here throughout the beginning part of this year, at least into early May. Same scenario here. We basically have got the slow in a almost flat configuration here. The medium speed in white is holding above that still bullishly, and now you're getting these minor oscillations back and forth of the fast. Another couple of examples. This is the flip side of those examples that we were looking at in the sugar market a moment ago in Genesis. Here's a case where we've cut back above. All oscillators have gotten above the zero line. We're bullishly configured at this point. It's the same is true of the STX material up on price, as well as the location of price relative to the NMA. We get a 1 bar penetration, it looks like, of the slowest of the STXs. That's occurring at a point where we're getting a conjunction by virtue of the fast coming back into a singularity with the regular component 4 line, while still holding significantly above the slowest. Prices then advance up again, and we make a more substantial and of longer duration pullback that basically drive the fast and regular back to very near the zero line, certainly below their lower standard deviation bands, and you get this minor overshoot of the slow component 4 line, but notice how admirably it's holding above the zero line during that process, and then of course the market simply turns from there and rockets back out to the upside. By the way, those had been discussed previously in the STX analysis as being locations where you were getting those 1 bar violations of the slowest of the STXs. And note how well the NMA itself was holding support at that location.